The market keeps tumbling, but my income keeps climbing. Curious how I'm making that happen? Stick around as we dive into my dividend portfolio and uncover how I'm turning market drops into a growing income stream. I have 31 holdings and it's a mix of stocks and ETFs, so let's jump right into it. Welcome to the channel. I'm the Swedish dividend investor. We are doing a breakdown of my 116K portfolio today. We will go through my holdings and how they have performed. This will be separated into 3 parts, so we can be as detailed as possible without going on for too long. Oh, and also, if you see huge fluctuations on my portfolio value in my thumbnails or when I mention it, keep in mind my portfolio is in Swedish crowns, and since I want to cater to a broad audience, I convert it to dollars. And as you know, exchange rates can swing a lot, making the portfolio value fluctuate quickly, even if my holdings in Swedish crowns are unchanged. As always, make sure to read the disclaimer in the description down below. I'm going from smallest to biggest position by invested capital, so not by value. Let's talk about the first one on the list. Position number 31. First on the list is a covered call ETF, JEPI or JEIP, JPM US Equity Premium Income Active ETF. This is not even 1% of invested capital, and with the markets getting crushed, it's even less in value. It is sitting at 0.9% of invested capital, and it's just a tracking position, so I can see how the ETF is doing and collecting a small amount of dividends while I wait for a bigger drop. The yield on cost is about 6.3%, but the dividend varies depending on the market volatility. And my income from holding this is at around $59 per year. Let's move on to the next position, which is a similar strategy. Position number 30. Alright, yet another tracking position and also a covered call ETF. This one is JEPQ or JEQP. JPM Nasdaq Equity Premium Income Active ETF. It's almost the same amount invested as the previous one, 0.92%. And oh boy, this one is getting stomped to the ground. They are down over 14% as the making of this video, and 9.5% since the ETF was available in early November. I'm down 17.6%, roughly $180, by a double whammy effect. The ETF is down and the euro has weakened, making the losses higher. Currencies are a double-edged sword. When the currency and the stock or ETF goes up, you'll get even higher returns. But as we saw, the other way around is also true. Sometimes I'm up on a holding even if the stock is down, but the currency is higher. Alright, enough rambling. Since this and the previous ETF hasn't been around for that long, I projected the current yield based on average dividend paid so far, and my yield on cost is sitting at around 8%. The income per year is sitting at around $77. Now let's switch gears a bit to something with a more stable income stream. Position number 29. Ares Capital, ARCC. Ares Capital is one of the largest business development companies in the USA, providing loans and financing to mid-sized businesses that may not have access to traditional bank lending. It focuses on private debt, mezzanine financing, and direct lending. It comprises 1.23% of my invested capital. My yield on cost is 10.38%, and this is a pure income play. Not only have I collected that sweet dividend since March of 2023, but I'm also up 11% during the making of this video. The company pays me around $120 per year. Moving on to another BDC with a different strategy. Position number 28. Pennant Park Floating Rate, PFLT. Pennant Park Floating Rate is a business development company that primarily invests in floating rate senior secured loans to middle market companies. Senior secured loans are loans backed by collateral and have the highest priority in repayment if a borrower defaults. This is 1.47% of my invested capital and is again an income play. with the yield on cost being 10.4%. I'm down about 10%, so I have a bit to go to break even. Riskier stocks I tend to keep as small positions. Yes, both S&P and Nasdaq is currently very risky considering the out of control valuations. They pay me $147 per year. Next up, we have a bank stock. Position number 27, Swedbank. Swedbank is one of Sweden's largest banks, focusing on retail banking, mortgages, and corporate lending across Sweden and the Baltics. Historically offering strong dividends, making it attractive for income investors. 1.58% of my invested capital. I don't really like banks, since they are pretty fast in cutting their dividend as soon as financial troubles are rumored to occur. However, as a customer of this bank, since they are skinning me alive with fees and little to no interest on my money, I want to get some of my money back. I've been holding this company since 2020 and my yield on cost is a massive 14.16%. With my dividends included, my total return is 111.83%. They pay me around $220 per year. Let's switch to a stock from the consumer sector, one that focuses on groceries. Position number 26. Axfood AB. A leading Swedish grocery retailer operating chains like Willys and Hemköp, strong focus on the growing discount segment and stable consumer demand. This is a defensive stock with consistent dividends. What can I say? I like my food and consumer packaged goods stocks. But I seem to never get a chance to buy this stock on the cheap. 1.64% of my invested capital. They have a good track record of hiking their dividend and have done so since the financial crisis. My yield on cost is 4.2% and I'm up about 1.66% currently. The yearly income is around $69. But now, let's take a look at a real estate investment trust that focus on a more diversified portfolio. Position number 25, WP Carey, WPC, is a diversified real estate investment trust, specializing in net lease properties across industrial, warehouse, retail, and office sectors. It has a diversified portfolio and owns properties across the US and Europe, reducing sector-specific risks. The net lease model means tenant cover taxes, maintenance, and insurance, providing WPC with a stable cash flow. It comprises 1.69% of my invested capital. I bought it in 2021 when the dollar was cheaper, so I'm only down about 2.44%, while getting over 5% yield on cost. My yearly income from this company is $105. Let's now shift to something that's a bit more telecom heavy. Position number 24, Verizon, VC. Verizon is a major US telecommunication company providing mobile, broadband, and TV services with a strong focus on 5G technology and network infrastructure. They offer consistent revenue from its large customer base in wireless and broadband services. Here I have invested 1.82% of my capital, and I started investing in late 2021. I'm down about 7.78%, but including dividends, my total return is 13%. They pay me around $111 per year. Moving on, we have another covered call ETF, but this one tracks the S&P 500. Position number 23. Global X S&P 500 covered calls ETF. Yet another covered call ETF. I like this since I can get exposure to larger indexes, but collect a high dividend yield instead of getting like 1.3% dividend yield from the S&P 500. I mean, even if the S&P drops by 50%, it's not even a 3% dividend yield. With this, I can average down and get income on the way. Covered call ETFs generate income by selling option contracts on the stocks in the fund, giving me a chance to earn higher dividends but capping the potential upside of the underlying stock. 1.87% of invested capital, 8.93% yield on cost, and not surprising, since the S&P is down, so am I. We can see it says minus 7.6%, but included dividends, I'm actually just above break even with 0.6%. Yearly income of around $175. Get ready for the next one. Position number 22. Global X Nasdaq 100 covered call ETF. Yes, I know, shocking. Another covered call ETF. It's 1.88% of my invested capital. What is not so shocking is the ETF is down, and just on the price it says I'm down 9.3%. With dividends included, I'm minus 0.03%. Ouch. My yield on cost is 11.48%, and my yearly income sits at roughly $250 per year. We are heading over to the final one for today. Position number 21. Vår Energi, a Norwegian oil and gas company focused on offshore production. A high dividend payer, but exposed to the oil price fluctuations and geopolitical risks. It's a pretty new position for me. I actually started buying oil stocks in September and November again, since I sold my positions during the oil peak of 2022. This is also one of those pure income plays. I've invested 2.07% of my capital, and my yield on cost is 14.44%. I could live with a dividend cut down to around 6 to 8% while I wait for oil to recover. Their break even is somewhere at around $30 to $40 per barrel. So we have a bit more to go before the pain would really start. Anything can happen. The oil could hit over $100 as well. No need to speculate. Just act on what's happening and buy a cyclical business when it's in max pain, or average down like I do. Then just wait for better times, because they will come. Out of all of these positions, which one would you consider adding to your own portfolio? Or maybe you would avoid a few? Drop your thoughts in the comments. I'd love to hear your reasoning. If you want to see the next part of my portfolio, make sure to hit the notification bell so you won't miss part 2 and 3. Don't forget to like and subscribe for more dividend investing videos. I'm the Swedish dividend investor, and I will see you in the next one. Stay smart, stay patient, and keep stacking those dividends. Ha det gött!